Good morning. Welcome to Market Wake Up. My name's Jordan. This is John, and you are in the one-stop shop to get into the know with everything you need before you start your trading day. We're going to be breaking down the macro mumbo jumbo for you right here. And today, John, I have a special treat. We usually do our big bite. It's usually pretty big. We usually slap some analysis, but I think I'm going to blow people away with my big bite today because I'm going to completely out myself and hold myself accountable through the whole month of October. So without further ado, let's get into Market Wake Up. Good morning, John. Welcome to Market Wake Up. Just gone 8:30 a.m. British Standard Time. How's your morning treating you? You're in a different place today.
Yeah, again, I don't want the viewers to think I am a proper part-timer, just here, there, and everywhere. Do you know what I mean? Because it seems like I go traveling a lot, but I'm actually helping a family member move house. So there's a good reason why I'm available. That's one thing about being in the industry that we're in. Sometimes we have some free time, and it gets asked upon us to do extracurricular activities. This being one is moving house. So yeah, I'm moving house I'm not moving house, but helping a family member move house in Dorset today. So yeah, in a different setup once again, but it's for good measure as well. NFP today. So am I going to be touching the charts anyway? Probably not. Have I touched the charts in 2-3 weeks? No. I feel like I'm not a trader anymore at this point. But yeah, I haven't done anything anyway for a while, so why not go and do something different for a change? Maybe after today, I'll be like, so glad I do the job that I do. When people like do moving and stuff. Yeah. So yeah, lucky in that sense. But yeah, other than that, I'm good. I'm excited for your big bite today. Exposing yourself, I hope in a professional way.
You know how we do it here at Market Wake Up. It's the big bite after all. So
we've got to get them views.
Yeah, I agree. I mean, telling anyone you're a trader or you work from home or you work from yourself is probably the worst thing you could do because that instantly goes, oh, he's not doing anything. Let's ask him. Yeah, that sums it up. 9 times out of 10, I tell people I have meetings when I don't have meetings, just so they don't call on me because I got shit to do or it's not my problem. So I agree with that. Paul, good morning to you. Malcolm's popping in. Good morning or good afternoon. Andrew, good afternoon to you. Everyone else who's chumming in, make sure you do give us a wave, say hello, introduce yourself. We do this live for a reason. It's so that we can have a chat. John's going to keep drinking his tea as we get into kind of what's happened yesterday. John, did anything tickle you? Did anything that we touched on? Obviously, we had the ISM services PMI and unemployment claims come out. Anything really catch your eye looking at these assets, looking at these results?
Obviously, the services PMI was a bit higher than anticipated, came in at 54.9. I think that was a little bit of a shock to the market. We've started to see dollar have this recovery. Bond yields were up yesterday. Whether this is again one of those ones where we were talking about the potential for a dollar reversal, whether that's mid to long term, though, I'm still 50-50 on at the moment. Short term, I like it. And the data at the moment is backing up a little bit of a dollar reversal. Tea, the drink of the devil. What? How? Why? But anyway, yeah. Other than that, not really anything catching my eye. There was geopolitically the action overnight. I try and keep an eye on now, see what's been going on, see if I've missed anything. Obviously, there's been lots of sort of bombing in the south of Lebanon now, but no. But from what I've seen anyway, I haven't seen any retaliations again from Iran at the moment. So that situation there isn't. It's horrible to say, but I keep saying things like it's not heating up as much as maybe the market's fearful of it right now, and it's such a horrible thing to kind of say. But yeah, that's that situation there. I'm kind of watching very closely, and there wasn't anything there overnight that was like, I suppose, too damning for the market. So yeah, but other than that, it's all going to be eyes on today, isn't it?
Yeah, NFP. We know how NFP's been acting recently. We know how NFPs are acted in history, so we know the volatility that's expected today, given into NFP, and we'll get into kind of our predictions for NFP shortly in Freshly Squeezed. But in terms of the ISM services PMI, did come in a little bit hot. Was a little surprised. I saw a lot of people commenting on the fact being like, "Oh, time to go, back up in rates." And I was like, well, that's a bit premature. I'm like, that's I don't know about that one. Like that's but yeah, it seems like the general sentiment is if we get any type of positive move out of the US, people are saying rate hikes are the answer, and that is just not what you want to be. Let me reaffirm this to every single person watching this. That is not the case, nor do you want it to be the case. But yeah, it's been an interesting setup there in terms of the Middle East situation. From my trader perspective, once again, disclaimer, we always talk from a trader's perspective, not from how we feel as humans or how we emotionally feel about a subject. We're talking from an investor and trader perspective. I think the biggest risk out of that, if I were Israel and I were to hit back at Iran, I wouldn't be hitting military targets. I'd be hitting their oil refineries. You can literally cripple their economy within, you land some good damage, you can cripple their economy. So I think the biggest risk right now is that, because if Israel do take that path and they want to hit the oil refineries, that's not just going to affect Iran. That's 20 to 30% of oil distribution around the world goes in and around Iran. So yeah, you expect your petrol prices to go through the roof. The cost of living question will come back into question. Oil prices, those going higher is a big problem. So that, for me, looking at that Middle East tensions is my risk, shall I say, is if those oil refineries are hit.
Yeah, I think that's a really good point. I was looking at that yesterday in terms of how much although Iran is heavily sanctioned when it comes to their economy in terms of their exporting and whatnot of oil, it is still a very interesting dynamic to think about, because what if we do see the retaliation from Israel into Iran and they do target those oil refineries, then is the inflation picture going to rear its head again? Because oil is usually a good indication of what's going to go on in the inflation picture. If we start to see oil prices rising again, is that going to have an impact on global inflation? The market's then going to be like, oh shit. So I wonder if any kind of political narrative has come in. What do you reckon the US have gone to Israel and gone, hang on a minute, don't do this right now. This could be. Would they even do that? Would they get involved like that? It'd be an interesting concept to think about. I think.
Yeah, they were involved 20 years ago. They're sitting there.
Yeah, that's true.
Hey, now would be a good chance for you to shoot that over there. I think that would be interesting. Give that a go. I think there's a devil on the shoulder of there's a lot more at play than what we can get an idea of. But nevertheless, that's my biggest risk play there. It does tie into something I'm going to chat about on the Big Bite here in just a little moment. For now, let's go ahead and shift over into Freshly Squeezed and have a look at what's happening in market conditions today. I am working on a laptop, so bear with me as I take a little bit longer. VIX up at 20.4. Okay, so VIX still sitting reasonably inflated compared to where we were at the beginning of the week. But let's get you through the major assets. The FTSE is up 0.19% today. The Nikkei is up 0.12. The XJO is down 0.07, and the S&P 500 is up 0.2%. So not too much there. Well, the VIX on the day down 0.5% as well. Looking at across the futures, you've got coffee down 0.6%, oil up 0.9%. We'll touch more on oil in just a moment. Gold up marginally 0.25%, silver up 0.4%, and sugar up 0.6%, which is interesting. Aussie dollar flat, euro flat, pound up 0.2%, US dollar Japanese yen down 0.5%, US dollar CAD flat, US dollar Swiss franc down 0.16%, Swiss franc remaining reasonably strong. Bitcoin up 1%, Ethereum up 1.3%, and it is interesting to see the way those assets are reacting in and around cryptocurrency with all this noise. Ahead of today, NFP is the big picture. US dollar movement, stock market movement is the expectation. VIX to the upside is the expectation. What is the forecast? Let me have a quick look. Average hourly earnings expected to drop. Growth still, but drop nevertheless. Unemployment rate expected to remain the same, and the unemployment change expected to be the same as what it was last time, 142K, expecting 147K. Do you have any out-of-the-box pitches for us, John?
Well, let me just show you this. I'm going to refer back to our little NFP seasonality chart that we spoke about a few months ago. Surprisingly, or unsurprisingly, however you want to take this, we've actually tracked really closely with the average. If we look at sort of 2023, which is the green line here, we can see that was slightly higher in terms of percentage. But 2024, very much tracking. We did kind of talk about this, I think, last month, or it might have been the month prior, that we should get a little bit of a bottoming out when it comes to sort of August going into September. And typically this season of in terms of economically is usually good for job markets, because we're going into the summer months, we're then coming into the winter months where we start to see sort of holidays, Christmas holidays, things like that. So we do often see a little bit of uptick in employment. So that's going to be an interesting dynamic to think about coming into the end of the year. Obviously, payrolls in terms of where they were, in terms of where they were at last year, are a lot lower. But in terms of percentage, it's not actually doing too bad, and it's following it. So we should we really be expecting some upward moves now in non-farm payrolls towards now and the end of the year? How is that going to impact the way the Fed cut rates? This is the whole picture, right? It's how is the labour market impacting the way in which the Fed cut interest rates at the moment? Obviously, we saw the 50 basis points cut. Now, again, it's the argument, are they going to do another 50 or 25? They're expecting the unemployment rate to rise to 4.4%. So they are expecting unemployment rates to move higher. So interesting data there. I think we're going to, forecasts, if we look at just the economic calendar here, forecasts are suggesting, we are going to see a little bit more of an uptick. If we just look at the sort of 2024 range at the moment, not too bad in terms of growth. We actually beat a lot of forecasts over 2023 and 2024. If we look at sort of September's figure last year, also beat forecasts as well. So yeah, I'm looking at this number and thinking we're probably going to get close to that. I would say probably, I wouldn't be surprised if we see like a 150 number, in my opinion. So we'll see how that impacts things. Yeah, in and around that area, I think it's fine. Again, it depends on the debate that everyone and where the market's focusing, because we've seen some big data points this week, but the market hasn't really shifted. So this is going to be the one I'm going to watch closely. The market's going to tell you what it's reacting to, right? We can see it at the moment. It's reacting to the geopolitical tensions. It's reacting to labour market situation. So when we see this data drop today, I'll be watching it in terms of, how does the market view this data point? Does it go aggressive? And do we see big moves? If we do, then it's really focusing on this type of data. So be interesting watch, Jord, I think. What do you think? You're thinking the 147s as well?
Yeah, I think that's a safe bet. I stick by it. I think we're all expecting a little bit of uptick at some point. I mean, I literally an hour and a half ago was sitting down with two recruiters over lunch and having a chat about kind of that market there, at least what's being felt locally. Extremely quiet on both businesses wanting to hire and people wanting to get hired, which I found very interesting. I was like, okay, this is different to me, and this is all types of roles across the whole. And this is a very large recruitment firm, so I found that very interesting. Where the job market's sitting, what's really being felt, and what the data is indicating. So I'm looking forward to seeing what comes out. But I do think those conditions are going to worsen. A little bit concerned about following a seasonal chart, given I do think the conditions are very different, and I think that is important to note. But I mean, the correlation between what we've seen so far and what we're seeing now, I mean, we're nailing it. Like, we're almost going to mirror it for the year. So that's not something you exactly want to ignore. 150, I think, is a safe bet.
Yeah, I think it's a safe bet. Quite interesting that. I would love to have that idea, right? Like maybe we should bring a recruitment onto the show, a recruiter onto the show, and ask
Is
them.
anyone going to
their
help
opinion on
themselves if they're in bad business conditions though? Like, are they going to just come in and go, "Yeah, I've got no work. Yeah, we suck."
No, we'll do it. You know how like breakfast shows do, and they're just like blank the person out in the background, and it's just like they change their voice.
Yeah, I know.
An anonymous tip here.
Yeah, anonymous tip. Yeah, I see where this is going. But no, I'm excited. Yes, Barry, you just said apparently Biden suggested yesterday that they would target the oil fields. It's a simple question of what would you do? I think modern day warfare is less about destroying the army and more about crippling the economy. You cripple the economy, you can't pay the army. Loyalty in armies is not what it used to be. Right, like 1940s and even earlier then, when you're fighting an axis of power, it was not doing it to get paid. It was doing it because you need to be there. Modern day, most people want to do things to get paid. Yeah, you know, and if you cripple the economy, what are they paying you with? There's a much smarter way of warfare, and I think that's what I would do in that situation. Once again, very horrible topic to be talking about, but that's how I would do it. Nevertheless, let's get John. Are you ready to get into today's Friday, the big bite?
Let's get my mind blown.
You ready to get your mind blown? Right.
Yeah, I'm ready.
So, as most of you know, we moved to a new channel last week. This is the second week. This is the completion of our second week. John is so excited that his camera froze. No, he's back. He's got a notepad.
Come on.
The notepads are out. I want everyone in chat sending a photo of the notepad.
I just want to let everybody know, right? A lot of the times, you know, me and Jord, we hide the big bites from each other, right? Because we want to get each other's natural reaction to the big bites, right? So if I'm watching this and I'm thinking, this is really good value, you got to take notes. I hope everyone in the chat does the exact same thing. You got to take notes. This is it. I'm here for it.
So yesterday, we had your big bite, which was a little bit confusing on defense stocks, not war, but generally economy defensive stocks, and then the tie-in of the US dollar. And I was like, right, I'm going to extend this. I'm going to dive in a little bit, okay? Andrew's going to buy some notes for next session. Love it. I think I know what you're getting each other for Christmas. He still owes me a beer for that Euro play. Let that be known.
I do.
Look, I did some diving, and I've got ideas on defense stocks. I know what I want to do with defense stocks. I just didn't find it sexy enough for a big bite. And I'm like, this is, you know, I want to say thank you to the guys that did follow us over from TradeDelicious, because we did see a little bit of a drop-off moving on to an independent channel, which was expected. But you guys remain true. You've come through. You show up every single morning and you chill out here with us and listen to our analysis and you join in. And I was like, these guys deserve something good. So I said, and we're not monetized by YouTube yet, so I can say this. I said, fuck it. I'm going to essentially show you my October playbook. I'm just going to tell you what I am doing through October and why, and I want your opinion. That's today's big bite. I am just going to brain dump what my plan is and let John essentially pick it apart.
This sounds fun. Yeah.
All right. I'm just going to rattle off about 8 different positions, and then we're going to dive into why. Okay?
Okay. Yeah, I like that. Yeah.
Throughout the whole of October.
Mm-hmm.
I'm shorting Euro Aussie dollar. We've already talked about that.
Yeah.
I'm monitoring the VIX, but I'm expecting uptick. I'm long crude oil. I'm long Apple. I'm long Amazon. I'm long Ryan Mattel, Lockheed Martin, and Raytheon. Okay? I'm also. I don't want to share the last one because I'm not convinced. Okay,
yeah.
Not convinced.
You said you're going to expose yourself.
Short the Nasdaq.
Okay, so it's actually quite just from initial thoughts there. It's actually quite hedged.
Yep. Correct. Now I'm gonna run into why this is the case now. Okay, so Euro Aussie dollar we can skip over. Big bite on Wednesday. If you missed it, go watch Wednesdays. I gave the whole rundown on why I'm shorting Euro Aussie, and I think that's a great play. Okay, stand by that. Then I'm moving into monitoring the VIX, because what I've actually done today was have a look at the VIX as an asset and really into like the seasonals of the VIX. So I'll share season asset chart here, okay, on the volatility index that you can see. Now you can see October is kind of where we top out, right? We really do top out on the VIX in and around October, and volatility drops into December. But you know what's really interesting is we're in an election year. So when we're in an election year, you stick two fingers up at this and you say, you're a joke. Let's get into the elections. If I go over here and just switch to election years, 8 years, 100% of the time, look at the climb we've had through October to the beginning of November, which is the election. The climb we've had into the election in the VIX, 8 out of 8, right? Since 1996, 100% of the time we've had a massive VIX climb up into the election. That is not something I want to ignore. That is something actually I arguably want to get behind. So I've said I'm monitoring the VIX, right? And the reality with the NASDAQ short is that VIX uptick, I can see the negative correlation is like negative 0.98 or something like that. Those are just inverse T. So the VIX play would be where shorting NASDAQ comes in. Now, I've confused you a little bit because I've also said I'm long Apple and long Amazon. And those two, obviously, hang on a minute, those are pretty large players out there, okay? When I'm long Apple and long Amazon, it's because we're running into earnings. Earnings are mid-October, I think 24th of October for both these stocks. Once again, if you were to have a look at these on the seasonal play, I mean, tell me, just look at this, John, and tell me where earnings is. It's, I mean, it's beautiful, right? Earnings is right
bang
here. That's where earnings comes in. And you can see this little run up we get right there. This is all the way 1999, okay? 1999, 81% with an average turn of 6%. That's on Apple itself. Now, I am also short in NASDAQ, so I'm not going heavy into these, and I've picked individuals because I think that pre-earnings run-up is going to remain true. I've been really successful on pre-earnings run-up so far this year. I want to continue that trend, both in Apple, and Amazon, right? So that's where that is. So slightly, but running into that. Then we move on to crude oil. Why am I looking at crude oil? Because I think it would be dumb not to. I think there's so many reasons right now for this to bottom. I just think there's so many reasons why this could bottom. War being one of them, okay? OPEC being another. The general, where we're moving the, sorry, my brain has just lapsed there. It's gone. Oh, shit.
Crude oil?
Yes, crude oil.
War, then you were talking about bottoming out?
Yes, sorry. Yeah, the war, the bottoming out, the change of conditions when Iran hit Israel, and the risk with them hitting those oil refineries, which we've spoken about, right? The risk of those. I think it'll be silly not to have a cheeky punt. We have already seen a rather decent downfall in oil prices of recent. Seasonally, oil is ugly in December. Let that be known. From October to December, it is ugly. But I think this is a cheeky punt. I think this is not something I'm saying right now I'm buying, but I think it's on my playbook. You know, it's somewhere through in around October I quite like. Then I moved on to your defense stocks. And this is where I had a lot of fun. Lockheed Martin, Raytheon Tech, both listed in the New York Stock Exchange, and Rheinmetall listed on the German Stock Exchange. During recessions, regardless of recessions, over 10-year periods, consistently outperform the S&P 500, regardless, even in growth conditions. The good thing that I like about these stocks is even if we do move into a recession, you know who their contracts are with? Governments. You know what doesn't stop spending? Governments. So even if us lose a lot of money. Businesses' conditions drop. Guess what? Their contracts aren't with everyday consumers. They don't care if you've got money. What they care about is the threat of war and government locking in contracts for 5 to 10 years, which is exactly what they do with companies like Lockheed Martin and Raytheon and Rheinmetall. That is something I want to be exposed to. That's my playbook.
I like it. Do you know what? I like the fact that it's hedged. Barry was like, I don't write that fast. You did rally them off quite quickly. And Andrew, what we're writing down? We're writing down George's playbook. That's what we're writing down. Barry did put some analysis in Discord. I haven't seen that. Sorry, Barry.
I haven't. Apologies.
Yeah.
You're better commenting on a stream because we actually get notified. We get notified and it sends it to our email, whereas Discord doesn't. Yeah. Or like tagging us on social media or something. Not necessarily Discord. Would be good on Twitter or something. Or our LinkedIn's if you want to get involved there. But yeah, I like this a lot. The only one I'm a little bit worried about right now is the oil one. I don't know whether we're just seeing is that a reaction trade, right? The price action looks a little bit less reactive because we haven't had the situation where it's rallied off of the news and then it's come back down in the overall trend. It's what you'd usually kind of look for. But when I was looking into sort of Iran myself, and I was looking at the situation with the oil refineries and stuff, a lot of talk is that would it have actually that much of an impact? I know 20% of I don't know whether is it 20% of the global supply comes through Iran. I'm not 100% on that, but yeah, when I was looking a little bit at it yesterday, they were like, is this going to be the one factor that really does drive oil prices up for longer? I think the good thing about this, and what's interesting as well, I was actually looking at the VIX yesterday and the seasonality on the VIX, and I was like, actually, for an election year in October, it does actually get a bit tasty on the VIX, which, again, is this we've kind of not almost glossed over the election, but it kind of has gone on the back burner a little bit, hasn't it, recently? Usually we would be hyping up the election, and I would be talking a lot about, well, actually the dollar gets a lot stronger leading up to an election and shortly after an election. So maybe we need to start thinking about that a little bit more. Me personally, anyway, I need to start thinking about that a little bit more. I think there's I've given you a lot to digest. Okay, so I'm going to let you digest it. And I'm going to overwhelm you even more with a quick take it to go, because I've got more analysis which I've done today, which I want to share. Okay. Today, I've been looking into the wonderful CME Fed Watch Tool. Now, you know we like the CME Fed Watch Tool, right? Predictions on where the Fed's going, right? And I've been having a look at the probabilities here so you can see the future of where we're sitting. We've already explained multiple times this is derived from the futures exchange. You know what really annoys me? No other leading economy does this like the CME does. No one puts it into probabilities. So you know what I did today? I went and did it for everyone. I went and did it. I'm going to give you the probabilities of, not the probabilities, but the predictions of where the futures market is pricing a lot of the major currency interest rates to be January 2025. Okay, so we know that the Fed right now are expected, when we come to January 2025, which is the 29th of January right here, there's a 44.8% chance that we're going to be at 3.75 to 4, right? In between 3.75% and 4% when it comes down to the interest rate. They actually smack that down in the middle. I will explain at a lot further date how it's actually priced those probabilities, because it's not the way that you think it is. Right now, I'm just going to list some off for you. The ECB is currently at 3.65%. Okay, that's their refinancing rate. It is expected come January to be at 2.65%, which is 100 basis points further down than where we are by January 2025. The RBA is at 4.35%, is expected January 2025 to be at 4.17%. That is a drop of only 18 basis points by January 2025. The Fed are at 5%. They're expected to be at 4.13%. That's a drop of 87 basis points by January 2025. Swiss National Bank is at 1%. Get this. December 2024, they're expected to be at 0.6%. And March 2025, they're expected to be at 0.4%. People are backing that the Swiss National Bank are going to get right the way down to almost zero interest rates. That's interesting to keep an eye on that picture, especially with the intervention. Bank of England sitting at 5%, expected to be at 4% by January. That's another 100 basis point drop. Across the board, what I've noticed from these predictions, everyone's cutting apart from the RBA go long Aussie dollar.
Yeah, I like that a lot. We're actually even seeing the RBNZ now starting to think about cutting rates as well, which I was going to talk about next week in one of the big bites. So yeah, it's interesting dynamic at the moment. We've got Aussie's strong. Aussie's been a strong currency, you know.
Aussie's strong.
Good strong.
However, mining sector is doing huge layoffs right now, which is concerning. Mm-hmm. That's what we produce. If the mining sector hurts, oh boy, Australia hurts. So that's one of the risks. I will explain how I got these figures, how I got these numbers, and how I did the math next week in a big bite. I'll give you a little presentation on how you can get through the futures market, how to read it, and how you can make these predictions yourself. But without further ado, guys, it's Friday. This weekend, get away from the charts. Get away from, I was going to say get away from your friends and your family. No, go spend some time with your friends and your family. Come back and join us on Monday, 8:30 a.m. British Standard Time. We'll do it all again. John, it's been another fantastic week. It's been a pleasure. Everyone else, let us know what you're up for the weekend, and we'll see you on Monday.
Cheers.